Welcome to RealCrunch Real Estate Analysis Software, example number 3, Multifamily. Modeling a small multifamily rental property using RealCrunch. For this example, what we're going to do is we're going to basically model a small multifamily property. Maybe we'll have, let's say, 4 units, and we're going to assume that you looked at some of the other videos, which will go more in depth into each one of the inputs. So here we'll just start putting some inputs in pretty quickly and go through, show you how quick we can do this. So project name, example 3, location where, and issue date, as we said, obviously the software doesn't automatically update it. You should choose any day that you want to set as the project or model issue date. So we'll say tomorrow, and say 4 unit multifamily rental. And our required return, let's set that to 15%. And purchase time, so let's go ahead and edit the property cost. Let's say we purchased this for about $150,000. We're financing, so the lender will include it to save. So here's the $150,000. We have a broker's fee. We can edit that. Say 5%. Then we can add other things too. So say market study. Maybe we did a small market study. It cost us 100, and home inspection. So there we go. So we can add all these up, and these are the purchase costs. Of course, we change the purchase time. Fixed values below here are evenly distributed across the purchase time, whereas percent of purchase, which is the property costs, all occur at the same time, which is the actual closing of the property or the sale. So, and those occur in the last month. So here we go. We got our total, subtotal, and let's add some improvements. Say we have some miscellaneous improvements. Owner won't include them in financing. So yeah, $2,500. Alright, so there we go. So we have our total project cost for acquiring. We got 1 month of improvement time. We're assuming that we have to do the improvements before people need to rent. If you don't, you can leave that at 0, and then you'll go right from purchase to the holding period. Alright, so next let's do the cash flow. Now the cash flow page is where we're going to put in our income and our expenses, and then at the bottom we're going to generate our property sale, the terminal value. So here we got the holding period set at 12 months. We're going to hold this for 4 years. For 48 months, always got to put it in months, and then you can convert the table values monthly or yearly. I prefer monthly. Alright, let's add some income. Let's add our 4 units. We add, just call it unit 1. We're making this up, so say 50, and based upon our research, let's say we about 1% a year. Average on vacancy loss and growth rate, let's say 3, and let's say unit 2. And for whatever reason, this one is much more desirable and has a small unit loss, and let's just say for whatever reason has a higher growth rate. So you don't. Each unit doesn't have to have the same vacancy or growth rate. You can have it individual for each one. So, say unit 3, say that's in the basement, and nobody likes to be there, and it has to stay cheap. And unit 4. And let's just say that's least desirable also. So here we go. Here's all the gross income for all these units. And then we can also add additional income items. If we have then we have a laundry machine, maybe that makes 125 a month. And really there's no, well, you can put a vacancy loss as if someone's not there using it. So say 2%, so you don't have a full unit. And yearly growth rate, usually those are fixed, because if you have coins, you have to figure out how you're going to do that. Okay, and anything else we want to add? You can, it's unlimited, so you can add it, and it's all adjusted here. And then we go to expenses, so let's add some. Now, here you can just either use a percent of total income and do all of them, or if you want to aggregate down to the unit, you can say, like unit 1 expense, unit 2 expense, but those you're going to have to do based on a fixed cost, because percent of total income is the total income. Here, just to make life quicker, well, let's give it a better name than that. Let's just lump them all together. So we're just going to say about, on this one we're going to be cruising around, let's just say 45%. And since you're using percent, you don't really need to put into an inflation because it will adjust. Alright, so for our model, instead of putting down taxes and phones and all that good stuff and utilities, we'll just do a percent of income. And here we go. So total income, net expenses, about half. Here's our NOI, net operating income. And then for our property sale, we bought that thing at, let me go back and check, we're at 163. Usually, you can readjust this later. Typically you go off the cap rate, but for the example, to do that, you'd have to, once you do the pro forma, you can adjust that value based on what your final NOI is. But for now, let's just say we're going to sell it around 180,000. And it's only going to take a month to sell. Broker's fee, we can edit that. 5, or you can just put in half if you're only paying half. And then anything else, say you can add legal fees. Say 2,000 for whatever purpose. So you can add fixed values or additional percentage of values. And again, if you increase the sale time, the fixed values down here will be distributed across. So if you had 2 sale time, 2 months, that'd be 1,000 each month. Now also, you do not derive income during the sale time. The program just assumes that you have to empty the unit. That might not be the case, but since you're just modeling, it's not a bad thing to consider, because you don't know who's purchasing it and what they're going to do, or if they'll even roll over the tenant. So there we are. Here's the cash flow page. Now we're going to jump to the finance page and see how we're going to finance this. The finance page is where we put in all our information for the project financing. The page here at the top, we have the general info, then the first lender, equity, and investors. So basically, what we have here is the total project cost, $163,750. Then the financeable, because some of those components the lender won't consider in the financing, decreases the financeable total down to $157,500. Now the first mortgage data we're going to put in is all contributed to. This is the value that the lender is going to apply these loan to values and stuff to. So loan to value, let's keep it at 80, just to make I'll leave it at 20 years. You can put 25, 28, whatever you want. Debt service coverage, let's say they want 1.2. Now it will readjust your total amount, which will lower your loan to value if your debt service coverage isn't made. So the software will catch your debt service coverage ratio. Okay, interest rate per year, let's just leave it at 4. Closing costs, say 3,000, and again, if you have broker's fees and they're going to roll it into those costs when you ask to them, just make sure you know so you don't double penalize yourself for including it twice. Okay, so there we go. From after the loan, we have 123 available capital. We need to come up with 40,000 equity. So let's add an equity line here. We use our hard money lender of choice, Fast Eddie, and he's going to give us 20 grand for 3,000 fees, and it's going to be an amortized loan, so it acts like a mortgage roughly, 14%, and 20 years at 250. So there we go. So after we decrease the fees, we only have 17,000 of actual capital that goes towards the project costs, and we still needed to come up with 17,000. And once again, for this example, add a credit card, and let's say it could be a HELOC or any line of credit. Let's say I got 7,000. No fees, it's a credit line. Interest rates 18%. And check your any of your credit lines will tell you a minimum balance that's applied each month. You put that percentage in there, and 315. So there we go. With the credit card and Fast Eddie, we're up to 24,000. We only have 16,000 left to capital, so let's bring in some investors. So say investor 1. Yeah, let's use 2 investors. So I'll get say 4,000. Now the order is important. Whoever you put in first gets paid first. Alright, so he's going to put 4,300. Let's give him a fixed payment. He wants 200 a month, and he wants at least 7,000 back, and he doesn't have a minimum IRR. These are just arbitrary, so he's putting in 4, he wants 7 back, and he wants to be paid 200 a month. Okay, let's add one more investor. Now this guy's paid after investor 1, the investor 2. He's also going to get 4,300, but he wants 20%, and percentage, he wants about 20%. But now he's got a minimum look-back IRR, so what the program's going to do is look at his cash flow and then it's going to make up at the end. So it's going to, at the sales price, the sales value as it's distributed, it's going to readjust that value to try to meet his IRR. If it can't, it's going to just take whatever's remaining, but it's going to readjust on the end if that 20% and this of the operating income and the profit, if that cash flow doesn't meet his return, then it's readjusted at the sale. So let's say he wants to make he wants 20%. Okay, so we add it. Okay, so there we go. So we got 8,600 from the investors, remaining equity 8,150 that comes out of our pocket. So okay, so next we'll go to the pro forma and see how the project itself is actually performing.